let's do a quick example on a damaged roof from hail and what that looks like as far as numbers, and just walk through the sort of the claims process with an example roof. So you got a roof, it sustains damage, you file the claim, and you realize that you do have an RCV policy, which allows you to kind of recover that depreciated value, which is great. So let's say that you get those documents back from insurance and they state that the RCV, or the, kind of the total value of the roof in today's dollars is, we'll just use easy math, is $10,000. So they say, we deem that roof to be worth $10,000. A contractor should be able to replace it for that amount of money. Awesome. They then say your roof is 10 years old on a 30-year shingle. So we'll just, take 10 on a 30, 33% depreciated. So take this, and this is a straight line. I don't know exactly how they calculate this, but just assume we're going to do like a straight line, easy depreciation on this. So we're going to have, depreciated value, or depreciation, of $3,333. So your ACV, or actual cash value, is going to be 10,000 minus, so your RCV 10,000 minus your depreciation gives you your actual cash value. This looks like, what is this? 667, if my math is right. And that is typically the check that they'll cut you in the beginning. Now, they're also going to take out your deductible. So let's say deductible is $1,000. So the check they're going to cut you is actually ACV minus deductible, because they just assume you're going to pay for that. They're not going to work, they're not going to take your $1,000 and put it on there. They're not going to give it back like that. They're just going to reduce it. So then your check that you're going to get, assuming my math is correct, we're just doing that on the fly, roughly $5,000. So as you can see, we've got a $10,000 roof, and they're going to give you $5,000. Now, don't assume that that's the money you get. With an RCV policy, after the roof is complete, we can submit a completion certificate signed by the contractor and typically the insured, or the homeowner, the client, and then we can recover this amount. And that brings us back to $9,000. That's important, because you still have to pay your deductible. That's always going to be out of pocket. But to get back to that $9,000, that's how you kind of run that policy all the way through. And that's the number you want to look at. ACV is what they're going to cut right away. It's simple, it's easy, it's a pretty straightforward calculation as far as how they get to that number. RCV minus depreciation equals ACV. Check they're going to cut you is ACV minus deductible, and that's what you're going to get up front to get your process started. Hope that helps.